Many risk-averse investors choose to invest in fixed deposits. It offers a certain percentage of return, is convenient, and more importantly, you can break a fixed deposit in times of need. However, fixed deposits offer a very low post-tax rate of return. Therefore, investors always look for an alternative to fixed deposits. Debt mutual funds can be a very good alternative to fixed deposits. However, one needs to be careful with respect to the choice of mutual funds, debt mutual funds. Commission earning brokers sometimes recommend debt funds which may not be appropriate to the investor or his investment objectives. Hence, it becomes important for us to understand how we go about investing in a debt mutual fund. Firstly, let us understand that debt mutual funds are a part of your total investment in debt. Follow your asset allocation. Find out how much is to be invested in debt. Understand that investment in schemes such as employee provident fund, public provident fund, post offices are also part of debt. We need to remove this to arrive at the amount of money that needs to be invested in a debt fund. Secondly, it is very important for us to understand the time horizon for which we need to invest the money in a debt fund. Ideally, a 3-year period works very well for a debt fund. However, if the requirement is to invest for a shorter term, then the type of funds in which we need to invest are different. People need to be wary of exit loads and the returns based on taxation to choose the right funds from a time horizon perspective. The next aspect of investing in a debt fund is to see the impact of interest rates on debt funds. A debt fund, unlike a fixed deposit, does not offer a fixed rate of return. A professional fund manager is managing your money, investing across multiple debt instruments. However, these instruments, or say bonds, will experience volatility in prices as interest rates change. Interest rates and bond prices have an inverse relationship. An increase in interest rates results in a fall in bond prices. An decrease in interest rates results in an increase in bond prices. Consequently, we see the NAV of the debt fund increasing or decreasing inversely in the direction of interest rates. When interest rates increase, the NAV may drop, resulting in a negative or a low return on a debt fund. This does not mean we should not be investing in a debt fund. Similarly, a fall in interest rate can result in a sudden surge in NAV and very high returns in debt funds. It is important to remember that these returns cannot be sustained unless interest rates continue to fall. Therefore, understanding the impact of interest rates on debt mutual funds is very important. What we need to keep in mind is also a concept of duration, which is in simple terms average maturity. This is mathematically calculated, but the number is available for us to understand. If the duration is high, then the impact of interest rates on bond prices is also high. If the duration is low, then the impact of change in interest rates on bond prices is also low. Therefore, the choice of mutual funds, debt mutual funds, should factor in the amount of duration for which the funds are invested. Different debt mutual funds follow different strategies on what kind of duration would they like to hold for their investments. So that becomes critical. The next factor that we need to worry about when we invest in debt funds is credit risk or default risk. If you are investing in a bond fund, you are essentially allowing your fund manager to lend money to various corporates. Now, it is possible that a company may default on its payment commitments. That results in a fall in the value of the debt fund. It need not be a default. A simple fall in credit rating can result in a fall in bond prices, resulting in a fall in a debt fund. Government securities are protected from default risk because the government will not default on its payment commitment. So, if an investor is looking for protection against default risk, then gilt funds are a better option for the investor. Therefore, the choice of a debt fund depends on the tax element, the time horizon for which we are investing, the duration of the fund, impact of interest rates, and the credit rating of the investments. So, keeping this in mind and adhering to the advice of a SEBI registered mutual investment advisor will help you choose the right debt fund. Happy investing.